Good afternoon. It is February the 6th, 2010. My name is Eric Bond. This is my final episode of Mortgage Macroeconomics for Everyone. This is part 3. I'm going to wrap it up. I appreciate your patience. I am getting somewhere, and we start like this. Let's go back to my analogy of Thunder Road. Our intrepid guitar-playing sheriff of Mayberry, North Carolina, does not have to guess who the moonshiner is in his county. The guy buying all the corn is the culprit, regardless he goes to the VFW every Friday night, or church on Sunday, or buys all the Girl Scout cookies. The guy with the corn is the moonshiner. All our intrepid sheriff has to do is place him at the site. Now, that's what we're talking about with regard to the site. If you look at what happened on July the 1st of 2009, a very large event happened. What happened was this: the European Central Bank contacted all of its member banks and told them it was going to do this. It was going to create 622 billion euros with 3 provisos. Number 1, they had to take it. Number 2, it had to be paid back within 1 year. And number 3, they had to pay it back with 1% interest. That's right. 622 billion euros paid back at 1% interest. To find out what happened and what's going on in the market, you have to look at who's got the money to do it. Was it the federal government? No, they were a little bit busy buying out General Motors and recapitalizing AIG and half the banks in the country. Wasn't them. Wasn't the Chinese. Chinese have got 1.2 billion mouths to feed. Although they do have the money to do so, they're not going to do it because they've got to buy materials so they can turn it into plasma TVs and send it back to us. The only ones that had the money to do it were the European central banks. Now let's turn that into cash, United States money. That is approximately 1.162 trillion United States dollars, which is a lot of money even in Texas. Let's take a look at that. Let me see. That would be the approximate gross national product of South America for a year. That's a lot of coffee beans, any way you want to stack that up. Now, that is a hyperinflationary scenario, but you can buffer that down if you do one thing. If you can put those monies into a closed system. Let's talk about a closed system. Let's say the United States government, whom we will refer to from here on out as Uncle Sam. Uncle Sam wants to repave all the streets in Dallas, Texas. Great. The inhabitants of Dallas, Texas now have happy motoring, smooth sailing, and a nice commute. The rest of the United States gets nothing, lives in a hellish, pothole-filled environment. Dallas doesn't care. The rest of the country is envious of Dallas. This is the closed system. This is an analogy of what I'm talking about. Now let's go to the end of our hyperinflationary scenario. What's going to happen at the termination of it? On or around July the 1st of 2010, you have your $10,000 Chevrolet again, and you have to sell it today. The unfortunate aspect is you have a million other people with the exact same Chevrolet, and they have to sell it today also. Congratulations, that $10,000 Chevrolet is now valueless, or maybe let's say it's worth $5,000. There's a lot of glut on the market. We're talking about the market forces of supply and demand. There's an oversupply now, and there's only one big demand player. Who's the demand player? That's our Uncle Sam. No one can sell their $10,000 Chevrolets anymore, so Uncle Sam is urged to intervene in the market. We're having a Black Swan Sigma event, and you got to bail us out because everybody knows that you rode on the hood of those cars. This car is worth $10,000. Thank you very much, your Uncle Sam. Uncle Sam says, sure, I'm buying. Come up to the cashier window, I'll give you your money. Uncle Sam reaches into his right hand pocket, pulls out 10,000 United States dollars, hands them over to everyone. reaches in his left-hand pocket and hands out $5,000. Monopoly money. Everybody goes, Uncle Sam, that's monopoly money. That's certainly no good. Uncle Sam goes, no, I've got it. It's a reserve note. It is for all debts, public and private, and it's signed by the Secretary of the Treasury of the United States of America. You can take your money or else. You're going to take your money. That's what is going to happen. Now, will the United States government intervene in the market beyond that? Very likely. The United States government intervenes in the markets. It's what it does. But in the meantime, the hyperinflationary event will have already transpired, and it's just going to be tough noogies for everybody. For instance, I walked in the grocery store the other day and I saw a loaf of bread, $3.89. I asked myself, when did bread start getting $4 a pop? Well, bread, based on the market forces of supply and demand, demands it be $4 because there's somebody out there buying $4 bread. The Chinese, the Indians, the Africans, they're buying this wheat and they're turning it into bread. They got plenty of money to buy it. Remember, they've got trillions of dollars sitting out there of United States dollar reserves. Who cares? They're going to spend what they've got. So they go ahead and buy that. Here is what I suspect will happen by the end of the year. If you like $4 bread, I hope you love it at $5. Gasoline should be, by the end of the year, $3.50 and above per gallon. And how about our old friend Jiffy Mix? Jiffy Mix 5 years ago was 25 cents per box. Last year and for the preceding 5 years, it was 33 cents a box. I'm from Texas. I buy a lot of cornbread. I know what I'm talking about. That box right there costs 49 cents. That's quite a bump. Now, what am I suspecting it's going to do? Our old friend Jiffy Mix is likely to be 79 cents by the end of the year. I hope I'm wrong. I don't see how I could possibly be wrong, particularly if the United States government has to recapture $1 trillion of their T-bills and securities, and Fannie Mae. You could look at a Fannie Mae bond. Well, that's a private company. Oh, really? It is a quasi-governmental entity now. We're talking about the federal government that has intervened across the board in all markets. I'm suggesting this. If you know anyone that needs to refinance a house or purchase a house, have them do it now. I would do it now. I would do it right now. I wouldn't quit. Number one, another thing, if you have an adjustable rate mortgage or a home equity line of credit, a balloon mortgage, or God forbid, a negatively amortized loan, you may find in your loan document somewhere the term fully indexed rate. Fully indexed rate is mortgage guy speak for you're going to the top. Whatever the rates are, you're going to them. There's nothing you're going to be able to do about it. Please get in a fixed formatted loan and do it quickly. Tell your friends to take a look at this video. If I'm wrong, no harm, no foul, but I'm not wrong. These are the facts that have happened. No one on your financial news networks are saying anything about this. No one has mentioned this. Diane Sawyer would not know what I'm talking about. Now, so please, if you need a mortgage in the great state of Texas, mortgagemonstertexas.com. I have very low fees and no overhead. This is my overhead. We'd be glad to do a loan for you and get you in a fixed formatted loan. That's the only thing I'll do. No trick mortgages anymore. I'll not do that ever again. So mortgagemonstertexas.com will route you. My toll-free number, you call that toll-free number, you get me. I don't have secretaries. Well, my wife might answer. But give me a call. Forward this video to your friends. Follow me on Twitter, twitter.com/mortgagemonster. I hope I've made sense. Have a great day, and thanks.